Hi everybody, this is Lara with your end of the week video for gold for the trading week ending Friday 29th of January. The situation still is unchanged from last week. We still have two Elliott Wave counts, one bearish, one bullish. Classic technical analysis slightly favours the bearish wave count at this time, but both are entirely valid. We do have to be open-minded and consider both possibilities until price tells us which wave count is correct. Elliott wave analysis first, classic analysis last. This is the bearish wave count at the weekly chart level. The higher degree picture at the monthly chart level sees a huge expanded flat unfolding, and they're pretty common corrective structures. This monthly chart level sees a big supercycle degree fourth wave continuing. At a lower time frame, here's an example of an expanded flat. They subdivide A, B, C. B moves beyond the start of A, and then C moves beyond the end of A. Here we have A, B moves beyond the start of A, expecting C to move beyond the end of A, so new lows below 1046 for this wave count are expected. The most common Fibonacci ratio for wave C within an expanded flat is for it to reach 1.618 the length of A, hence the target at 657. From this high in August 2020, we do still have a series of lower highs and lower lows, and importantly, this swing high did not take out this swing high, so that pattern remains intact. But this week, we don't have a new swing low, and so the bullish wave count also remains valid, and we have to consider both possibilities and be open-minded. For this wave count, if we see a new swing high, I'm probably going to discard it prior to final invalidation. This wave count would be finally invalidated with a new high above the all-time high for gold. This invalidation point is absolute. A new high by a fraction of a cent on a tick chart immediately invalidates it. That's one of the nice things about Elliott Wave. The rules, all bar one, are absolute, and so you know when your wave count is wrong. Let's take a look at the daily chart level. We're going to look from the end of supercycle B up here. This point here, here's our series of lower lows and lower swing highs. And this swing high was not taken out, and now this is the last swing high. If this swing high is invalidated with a new high by any amount at any time frame, I will probably discard a bearish wave count in favour of the bullish wave count. Within Minuet wave 3, no second wave correction may move beyond its start. This best fit channel has been redrawn for better technical significance. Along the way down, deeper bounces are finding resistance about the upper edge of this channel. So if we do see a surprise deeper bounce next week, I would be looking for final resistance at this trend line. Within Minuet wave 3, it's possible we have a series of a couple of overlapping second waves. It's also possible to label this 1 and 2 continuing higher. We could see another one of these big bounces up to resistance. This is the final risk point for this bearish wave count. If we have a new trend at supercycle degree, then the first 5 down should unfold at the weekly chart level. I'll label that primary 1 and it's incomplete. We can't see a clear 5 down at the daily chart level yet, which is what we should see developing for a new trend. So far, I'm labelling this a series of 1, 2, 3, 4 overlapping first and second waves. A third wave down at least 4 degrees may have begun here. The target for minute 3 is for it to reach 2.618, the length of minute 1. At the hourly chart level, I have 2 short-term pictures for this wave count. It's possible that within Minuet wave 3, within minute 3, subminuet 1 and 2 are complete off to the left of the chart, and now within subminuet 3, micro 1 and 2 are complete. Micro 2 moving higher on Friday, so that submicro C moved beyond the end of A, a truncation is avoided. Micro 2 now looks like a pretty obvious 3-wave structure, and it didn't move beyond the start of 1, it ended within the necessary small target zone or small area for it to end, for this wave count to remain valid. It's possible that we have a third wave down at multiple degrees just about to begin early next week. We could possibly finally see a new swing low, adding confidence to this wave count next week. Alternatively, it's also possible that subminuet 2 is incomplete, and as an expanded flat, A, B, C, as I briefly outlined for you at the daily chart level. Micro C to complete as a 5-wave structure with 1, 2, 3, 4, 5 to complete. The target is for micro C to reach 2.618, the length of A, and subminuet 2 may not move beyond the start of subminuet 1. As I said at the daily chart level, this is the final risk point for this wave count. At the weekly chart level, this is a bullish wave count for gold. We need to be open-minded at this point and consider both possibilities because there is support from classic technical analysis for both views. If the bear market for gold was over in December 2015 at 1046, it will subdivide as a double zigzag, and that's how I see it for both wave counts at the monthly chart level. It could have been a grand supercycle degree 4th wave over there, although it would have been rather brief for a grand supercycle degree correction. But let's consider all possibilities. If we have a new bull market for gold, then the first move up in the first new wave and the start of a new market trend should subdivide in Elliott wave terms as a 5-wave structure. From this low to this high, we can see a 5-wave structure complete here, and I'll label it cycle wave 1. The following move should be a counter trend movement, an Elliott wave corrective structure. I'm going to label it over here as cycle wave 2. Mostly because this is so choppy and overlapping, if I label cycle 2 over here, it's difficult to see another 5 up in this move here. But if cycle 2 is over here, it fits well as a double flat, W, X, Y. The first flat correction, labelled primary wave W, is an expanded flat, labelled A, B, C, and within C we must see a 5-wave structure, 1, 2, 3, 4, 5. The biggest difference in terms of Elliott wave subdivisions, and the reason why I keep pointing it out, is so you understand the difference between the two wave counts. This is the key problem in the bullish wave count. There's a triangle in this position, but triangles do not subdivide as the sole corrective structure for a second wave. So for this bullish wave count, we have to ignore what looks like a pretty obvious triangle at all time frames and see it as a series of overlapping first and second waves. Whereas if you go back to the first weekly chart, you'll see I can see this as a B wave triangle. But for this wave count from this high to this low, we have to see a 5-wave structure, which means we have to ignore the triangle. But this is entirely possible. It seems somewhat forced back in here, but it will work. I've got 2 weekly charts for the bullish scenario. The first one sees cycle 3 over here, and the second one considers the idea that cycle 3 is still incomplete. If cycle 3 is over here, cycle 4 could be a complete double zigzag. It's a lot more brief in duration than cycle 2. They're both labelled WXY, but they're actually quite different structures. This is part of the zigzag family, they have a strong slope. This is part of the combination or double flat family, they have a sideways movement. They have a different purpose. Double zigzags exist to deepen a correction, whereas double combinations or double flats exist to take up time and move price sideways. So there is actually alternation between cycle 2 and 4. There's very poor proportion though, which does reduce the probability of this wave count, and that's the reason why I'm considering my alternate weekly chart for the bullish scenario. If cycle 4 is over here, it subdivides very well indeed at lower time frames as a double zigzag. If it were to continue lower at this point, it would probably have to be as a triple zigzag. The rarity of that structure means that's unlikely, but again, consider all possibilities. If it did continue lower as a rare triple zigzag, it may not move into wave 1 price territory. Let's take a look at this at the daily chart level, where cycle 3 is this high here, this point here. Here's cycle 4 as a double zigzag. The subdivisions here are really good. This looks like a very good double zigzag. W, X, Y, cycle primary wave W, a zigzag, A, B, C with a nice triangle for intermediate B, joined by a 3 in the opposite direction, a zigzag labelled primary X, A, B, C, another zigzag labelled primary wave Y, completes a possible double zigzag for cycle wave 4. But now we come into another problem for the bullish wave count. From this low to this high, If cycle 4 is over here, this should subdivide as an Elliott Wave 5-wave motive structure. It simply will not fit as a leading diagonal. It's possible to see it at lower time frames as a simple impulse, but it seems forced. There's too much choppy overlapping in here. This movement has a much better fit for the bearish wave count than it does for the bullish wave count. I haven't put the labels in at the daily chart level because you have to go down to the hourly chart level to see where those labels should be. From this high to this low, it's possible we have a pullback, and that means for this wave count, a third wave may have begun down here. The target is for it to reach 1.618, the length of the first wave, because that fits with the higher target for cycle 5 to reach 1.618, the length of cycle 1. Intermediate 2 may not move beyond the start of intermediate 1 below the invalidation point. For this bullish wave count, if this invalidation point is breached, then as I tried to outline for you at the weekly chart level, I would then consider the possibility that cycle 4 is continuing lower as a relatively rare triple zigzag. The rarity of that structure means I'm going to label cycle 4 over here and consider for the bullish wave count the more common scenario. If we consider the more common Elliott wave structure, then logically we should be right more often than we are wrong. At the hourly chart level, here's the end of intermediate 2 and the start of intermediate 3 with minor 1, minor 2, a double zigzag. Minor 3 may have begun with a series of 2 overlapping first and second waves, so intermediate 3 may now be moving towards its middle in the next week or two. This wave count expects an increase in upward momentum in coming weeks. At the weekly chart level, this is the alternate idea for the bullish wave count. Instead of seeing cycle 3 and 4 over here, what if this is just primary 3 within cycle 3? Cycle 3 extending with primary 1, 2, 3, 4, 5. You do really want to see from this low to this high or this high, and I'm labeling it over on this week here because I'm labeling primary 2 as an expanded flat. At lower time frames, this fits really well. From this low to this high, this looks like a pretty obvious 5-wave impulse, the simplest Elliott wave structure. So I want to label that over here for primary 1. Primary 2, a relatively brief expanded flat. Primary 3 has a fairly typical curved look for gold's third waves. That's really normal. Over my 11 years of analysing this market every day, I'm quite used to now seeing gold's third waves have that curved look to them, with brief shallow fourth waves counterpart to deeper, often deeper, and definitely usually more time-consuming second waves. This is a normal look for gold's third wave impulses because, typical of commodities, it exhibits spikes with strong upward movement, and it does the same thing for strong downward movement, selling climaxes and blow-off tops. And when it does that in Elliott wave terms, that's a strong fifth wave. That tendency is especially prevalent for fifth waves to end third wave impulses 1 degree higher. And it gives gold's third wave impulses typically quite a curved look. So this looks normal. I've got no problem with the disproportion here between intermediate 4 being brief and intermediate 2 taking more time. However, I have a problem here with primary 4 taking a lot longer than primary 2. There's alternation between a double zigzag of primary 4 and an expanded flat of primary 2, but primary 4 is much longer in duration than its counterpart primary 2. So no matter how I've tried to label this upward movement here, if we see it as incomplete and as part of a bull market, there's going to be a problem of disproportion. This pullback is much longer in duration than any of these previous pullbacks within this upward movement, giving it an odd look. If primary 4 continues lower, it may not move into primary 1 price territory. Classic technical analysis. This is the bull market for gold up to the last all-time high, and at this point ADX reached very extreme. It was above both 45 and it's above its directional lines for the upward trend. RSI reached overbought and there exhibited clear long-term double bearish divergence with price. When we have extreme conditions like that, and we have that divergence after after RSI reached extreme, and then we see strong bearish candlestick patterns, we have to take that seriously. That means it is entirely possible that there was a sustainable high up here, and that this is the start of a new trend. That is a possibility we do need to consider. From this high, we still have this series of lower highs and lower lows. While this last swing high remains intact, that view of a possible new downward trend must be understood to be possible. We do have to be open-minded and consider all possibilities. If this swing high is taken out, then I would say that this pullback was over and gold is on its way to new all-time highs, but that is not the case this week. This pullback, though, has been enough to bring RSI well down from extreme, and ADX well down from extreme, and RSI well into neutral territory. There is again room for the prior bull market for gold to continue. Again, we have to be open-minded and consider both possibilities until price tells us which one is correct. This week completes a higher high and a higher low upward movement, but the candlestick, a small doji, is red. Essentially, we've got sideways movement with a slight upward bias this week. We need to look inside the week to understand the short-term volume profile. On-balance volume at the weekly chart level gives us no signal this week. We've been over ADX. ATR is essentially flat as price falls. That's actually pretty normal for the early stages of a new trend for gold. If you want to look back at that previous high in 2011, have a look at how gold started that downward trend. It did start with a strong downward movement, as we've seen here, but then it had a lot of choppy overlapping movement and had very deep bounces early on in that new trend. So that's actually pretty normal for ATR to be flat, as it has that sideways movement in a new trend. It's also absolutely normal for a counter trend movement, and so my point with this is that ATR is not going to give us information either way as to which of those two scenarios is most likely, sadly. Stochastics in neutral territory, MACD bearish. What about the daily chart level? How's the volume profile looking for this week? We've got some push for upward movement here, but the candlestick is red, so it's giving us mixed signals. For Friday's session, price moved higher, and the candlestick is green, but it has a lack of support from volume. Volume was lighter than the prior day, so volume isn't supporting upward movement for Friday, and Thursday and Friday sessions have long upper wicks. That's bearish. I give a lot of weight to these wicks. I would expect downward movement early next week as most likely. How much? The wicks aren't telling us. The direction is what they're telling us, not the distance. Look out for strong support again. About 1800 has held this week. On balance volume, the last signal it gave at the daily chart level was a break below support. The support line is long held, but it has quite a slope and it doesn't have many tests, so this is not a strong signal, but it is a bearish signal to support a bearish wave count. RSI is in neutral territory, plenty of room for price to rise or fall. ADX was telling us there's a downward trend. It's declining at the end of the week, telling us there's no clear trend. But if the black ADX line again turns up, then it would tell us there is a downward trend which is nowhere near extreme, plenty of room for it to continue. ATR is declining as price moves sideways. That's pretty normal in a counter trend movement. Stochastics is neutral and MACD bearish. That's all from me with your gold analysis this week, and I hope all of our members are having a fabulous weekend.